Hey everyone, thank you so much for joining the podcast today. Today, me and Jeff Nash just wanted to discuss the fastest growing, fastest evolving, and definitely one of the most confusing options out there in the marketplace. And that's the RIA world. As the broker dealer space continues to consolidate, the RIA space is just expanding at such an exponential pace. And almost every day, it seems like there's either a new firm, partner, or vendor out there that solves something that takes away a lot of the reasons for a financial advisor to say no. And we just wanted to give you an overall update on the RIA space, just talk about, what we're seeing and just give you a really in-depth understanding of the different types of options that are out there right now. So, Jeff, I really appreciate you hopping on to educate everyone on the call.
Yeah, absolutely. Really appreciate this. It's always fun doing these with you, Corey.
Yeah, for sure. Thanks for hopping on again. Just really quickly before we get started, I think sometimes people use, the RIA term a little too broadly. So just for the case today of what we plan on talking about, do you just kind of want to give like an overall education or like definition of like what an RIA is for like the purpose of this call?
So as we start to think about the RIA space, there are essentially the industry here over the last 10 and even 20 years has shifted to fee-based asset management. And what most people don't even understand is that when you're doing fee-based asset management, you're doing that as an IAR, right? That means an individual advisor, right? Independent advisor representative that is, they're managing the accounts for clients under a fee basis and is what they're doing. And then they're running that under a firm's RIA. And so when we think of an RIA, it could literally be Merrill Lynch, right, where it's an RIA. It could be LPL Financial, where it's an RIA, because the advisor themselves are managing money on a fee basis. But what we're really referring to here is those at firms that are really, it's almost the next gen, right? These are registered investment advisors, which is what an RIA stands for, and the advisor is the IAR. And it's really important to understand the distinctions on that. And these firms really use custodians. They're really, many of them don't even have a broker dealer, or the broker dealer is an entirely different organization. And so when we talk about the RIA space, we're really thinking about it as a firm that's a standalone entity that only does fee-based asset management. Now that's at the firm level, right? So again, with Merrill Lynch, we all know Merrill Lynch has investments, which can be commission and fee accounts, right? And LPL would be the same thing. It could be investments, which could be commission and fee accounts. And these RIAs in a true RIA setting, they really are just the fee accounts. Now they may partner with a different firm that's almost always going to have a different name. That is going to be the broker dealer side. That's the commission side, but it's the RIA side, which is the fee account. And that's what we're talking about. And these firms are typically custodying their assets at companies like Schwab, Fidelity's IWS channel, Pershing's PAS, even Goldman Sachs or Altruist as a newer startup that we're hearing a lot more about here in 2026. And those are just true custodians. So they're just holding the assets where trades are placed, where technology is done. But the RIA is the account that is the regulatory oversight that is charging the fees and managing the underlying accounts. So when we talk about the RIA space, we're really just talking about these firms. Now, this is what's really interesting, right? And this is what you just mentioned, is consolidation. I've been in the industry now over 25 years. And when I was in the industry, there were over 5,000 broker dealers. And now there's fewer than 4,000 broker dealers. So it's been a lot of consolidation and continues. And it seems like the consolidation is accelerating. And it's also accelerating across bigger firms, as we most recently saw LPL acquiring Commonwealth Financial just last year. Those are two of the largest independent broker dealers. What we've seen in the RIA space is the exact opposite. And we've seen more new RIAs starting every year. And so the RIA industry as a market is actually expanding at a much greater rate. And this is why we wanted to talk about some of this stuff today, is to help people understand what are the differences in the different RIAs, what's going on in the RIA space, why is it expanding? And it's expanding even though we see in the press about M&A and consolidation. It's still each year net new is growing. It's a growing and larger number.
Yeah, I mean, I just wanted to set the stage here. If you've been interested in the RIA space and maybe you've taken a break from your due diligence and you haven't taken a look in 6 months or a year, like you're completely out of date in terms of what the offerings are out there in the industry. I mean, Jeff, we just talked about this on a call the other day, but there's 15 consultants inside of our organization. We're all helping advisors explore the marketplace on a regular basis. We're constantly exploring the industry, and we have weekly calls, and we're learning about something new every single week. All of a sudden, a $5 billion plus RIA that we've never heard of comes onto our radar. There's just so much money being dumped into this industry right now. Smart money from private equity, family offices, other institutional capital. And it's just giving entrepreneurial financial advisors or leaders of organizations just the ability to build and really innovate in the RIA space. So I talked about it in the beginning of this call, but almost every single week we're coming across some really unique firm that has solved for something that's just made advisors really uneasy about making a move to the RIA side in the past. And that is now solved for, which is just super exciting from our seat.
That pace I expect is going to continue to even accelerate. And what's really interesting about some of these things is it's changed the dynamic as well, right? So when we think about the RIA space over the last 5 and 10 years, RIA space, a lot of it was fueled by a couple of things: breakaway teams, even coming from wirehouses, or even independent broker dealers starting their own independent RIA and growing and expanding and getting economies of scale, and then even getting private equity backing behind them. Now we're starting to see, just in the last couple of weeks alone, I've had conversations with one particular RIA, which is venture capital backed, and we're seeing firms that are now VC backed. And so I know there's actually been a couple out there that I've actually been speaking with. I'm sure there's a few more that I haven't even heard of yet. And that's a new shift in the marketplace. Also, another conversation I had recently was a company that actually started a proprietary technology, a fintech, right? So we see financial technology and AI being absolutely heavily financed and funded. And there's a company that I just had a conversation with that was a fintech company that now bought an RIA and is also looking to expand into and acquiring more RIAs. And so we see not just the legacy financial advisors running firms and then bringing other financial advisors together. We're seeing other industries coming into this space who don't even have a lot of that experience and are acquiring assets. They're financing assets, right? Asset growth, and they're building these firms. And some of them are actually really compelling. They've created some disruptive technologies in some cases. In other cases, they've created a disruptive approach to just drive efficiencies. And again, there are pros and cons to everything out there. I think the message here that you're started, and I'm kind of just providing a little bit more clarity and detail, is this expansion is going to continue. And with the investments that are coming into this marketplace, we're going to see more choices, more variability, and more opportunities for advisors, which is really can create more complexity as well.
Yeah, 100%. I mean, it just seems like almost everything is getting solved for, whether you don't want to do back office things and you just want to focus on being a financial advisor and meeting with clients. You have the ability to outsource all of that, whether it's research or outsource money management or taking down office space or outsourcing HR functions as an independent financial advisor, which nobody really gets excited about. And everyone would really like to outsource. It just seems like there's something new every single day that's being solved for, even if it's not inside of, a partner firm like we're talking about today, with some sort of outside vendor that's, or just a really entrepreneurial person that's identified a real headache for financial advisors that are running their own business and solve for it. So it's just really cool to learn about it on a daily basis.
And this is where the challenges and the complexities come in, right? So we've got new firms that are starting, and we've got new firms that are growing, and new firms that are expanding, and they're having success, with advisors joining them. And some of the complexities become, well, what are the negatives of all of these, right? What are the challenges that they all present? And some of the challenges is the same challenges that we see of larger firms, right? The consolidation. And so we're going to continue to see consolidation in the RIA space as well, right? So as many new starts as we have, we're still seeing a mass amount of consolidation. And there's an opportunity for some of these firms that are going to also consolidate, right? They're going to want to monetize their business, make money. How do they make money? There are two ways. One is they sell to another institutional investor, or two is they sell to a strategic buyer. right? And some of these larger RIAs, they're now in excess of 100 billion in assets with market valuations, market cap valuations that are larger than some of the larger independent broker dealers even. So they've got size and scale. They've got financing to actually build out new technologies. They've got support and a kind of a checkbook where they can actually acquire some of these new innovative firms. Not that that's dissimilar that we see in the just the the regular industry for the stock market, right? We see Microsoft and Apple or Amazon or Google buying companies that have new startup technologies and paying billions of dollars for startups. So we're going to see some of that consolidation. So then it becomes a question of, what are the risks? What are the opportunities? How are you protected as an advisor, right? Making sure that you understand the pros and cons and where the future could be with some of these opportunities. And that's a lot of the work that we end up doing is to try to help the advisors see through some of that stuff.
Hey, breaking in real quick. I really hope you're enjoying this episode and finding my YouTube channel of value. If you're a high performing financial advisor that can use somebody as a guide or a resource to explore all your transition options out there in the marketplace, I'm a non-biased, independent transition consultant that can help make this process so much easier for you. And another plus, it costs absolutely nothing to work with me. If you want to have a conversation, please feel free to text, call, email, DM me. My contact information is all over this episode, and I'll let you get back to it. For sure. And we're going to definitely do some high level overviews of some of the different options that are out there and what we're seeing. But Jeff, are there any, other significant RIA trends for somebody that might be interested in the space that you want to talk about?
Yeah, I mean, one of the big trends is certainly in the M&A side of the RIA. And we've talked about this in the past, and when we look at the M&A side of the RIA space, this is ultimately what's fueling all of this. And so it's not even the advisors selling their businesses, it's the actual value of these RIAs. And the value of these RIAs, as we see an RIA that could be a couple billion in size, right? Their value on multiples on EBITDA, it's low double digits, 10, 12, 13, 14, something in that neighborhood. And they see the opportunity and the pricing of the marketplace where they can bring in more advisors. They can expand their multiple really rapidly by bringing in more advisors and the value of their business. And so everybody's looking at how do they capture that upside, right? And what are the and that gets captured in a lot of different ways. One is it's getting captured in what we call drag along, tag along. It's getting captured in roll up opportunities. It's getting captured in buying books of business. All of these things are how they're getting captured. And essentially, the way you want to think about it, if you're an advisor wanting to better understand these things, the more the firm can control you and your clients, the more the firm's value is. And so short term, firms could become just a really strong platform. But if the firm themselves are trying to enhance the value of the firm, they're going to look to try to control you and your clients. How do they do that? Some of it's just providing services, right? What kind of services? They can provide power planning services. They can provide administrative support services. They can provide financial, not just financial planning, but investment management services. And the more you leverage all of these tools, it doesn't necessarily detract from your individual value, but it definitely enhances their value. And so these are all resources that advisors love to outsource, by the way, because they're just expensive, they're time consuming, it distracts from just the absolute growth rate, managing more people. These are all things that advisors value, right? If we look at traditional wirehouse advisors, these are today exactly what wirehouse advisors are outsourcing to the firm. Administrative support, investment management, right? There's a ton that gets outsourced. And that's exactly why some of the wirehouse advisors have internal programs that are pennies on the dollar valued when we talk about succession planning, right? The internal sunset programs. So those are things to watch out for, is making sure that you're not going into a program, into a firm that could actually detract from your individual value while it's helping the firm grow their value.
I mean, just to add on to that, Jeff, another, big thing that I've seen over the last year or so, you talked about the awesome valuations, low double digits, EBITDA multiples for being able to sell or merge with a larger, RIA, but that's happening straight out of the wirehouse right now. Prior to a couple years ago, in order to, extract those multiples that we're talking about out of your business, you had to go independent, wait for a year or two, and see where kind of the chips fell from a retention and a growth standpoint, and then sell your business. But there's a lot of private equity backed RIAs out there now that see the value, see how successful these wirehouse advisors are moving from the wirehouse to the RIA world. And they're allowing them to monetize from day one. And literally from the wirehouse, taking a look at a 2.5 times to, generous 2.5 times trailing 12 revenue valuation of your business at ordinary income at the wirehouse. I mean, immediately you have the ability to make the move to the RIA side and day one, get 5, 6 times trailing 12 revenue for the value of your practice. So that's something that's very new. I know wirehouse advisors are very excited about. So I just figured that I would bring that up as a new trend.
Yeah, I mean, and don't forget that 5, 6 times is at almost always typically at cap gains as well. And so the
Thank
net
you.
difference, and I had a conversation with a team recently, and I literally said, "Hey, your net difference could be 2 or 3x." And they're like, "Wait, what do you mean 2, 3 times revenue?" I'm like, "No, no, no, 2 or 3x." And I walked through the math with them of what their current valuation was based on what the firm had told them, and walked through what an actual similar deal was that we recently closed, and it was literally 2.5 times on a similar sized business, net numbers. And so it's huge different differentials. But I think the other thing that's interesting about this is you talk about the affinity on the RIA side for these advisors. Well, one of the reasons is the why, right? And what we're seeing in the evolving marketplace in the RIA space is firms that are getting the max multiples, right? The sell firms, right? The merging into the large organization. Those ones that are getting the max multiples have a couple of things that they've achieved. Number one is they're certainly financial planning centric. Number two is they've got a great team with varying aged advisors. And number three is they're growing the business, right? Fewer than 15% of advisors across the industry grow their business at 10% a year. So when it's not a huge number, but those advisors that are growing the business, and those become that much more appealing to these RIA firms. Well, what do we know about wirehouse advisors? Wirehouse advisors have typically, as a team, have built great teams with multi-aged advisors, and they're growing, and they do financial planning and investment management, fee-based asset management. And that growth that many of them have is really highly sought after by the RIA space. And so what we've seen, we have probably 25 or 30 different PE-backed RIAs that we work with at any point in time when we're doing a sell-side representation. At least half of them, just in the last 6 months, have reached out to me and say, "Look, we're really interested in the wirehouse space, and we've built out a new platform. We just did our first. We are trying to do our first." Whatever their situation is, they're all incredibly interested and intrigued about how to get more breakaways from the wirehouse to actually be able, because they know the numbers could be huge for both the wirehouse teams and for themselves based on the traditional growth rate and business model. So it's a marriage that we're going to see in 2026, a lot more of this happening. We'll see even more of that again in 2027 because we're just starting to kind of break the ice. But if you build it, they will come, is the old expression, and there's a huge demand and a huge opportunity for these teams.
100%. And the capital is obviously there on the RIA space for financial advisors that want to sell their business. But a pretty big trend I've seen this year as well, Jeff, just for financial advisors that are interested in the RIA channel. Until a couple years ago, you either kind of had to make a choice. You had to make a choice. Hey, I want to get upfront money. I have to make a move to either a regional broker dealer or an independent broker dealer, or I am getting no capital whatsoever and make the move to the RIA world. And with all of this capital that's coming into the industry, that's not necessarily the case anymore. If you want to make the move to the RIA channel and upfront capital is important to you, we're starting to see more and more RIAs that are offering independent broker dealer style capital or deals to financial advisors and still be on the custody platform. So as these firms continue to evolve, we're just seeing more of that every single day. And in the past, many people have made that choice. And, now a lot of these firms, especially the larger RIAs, are really giving, some of these independent broker-dealers a run for their money.
Well, and let's look at that from just so a lot of advisors that haven't looked around are under the impression that the only proper way to get their clients serviced is inside of a wirehouse, right? And what's happened here in this industry, in the RIA space, is that's just not true any longer, right? So the access to the separate account money managers, aside from the proprietary ones, is completely available and typically phenomenally well priced. The access to alternative investments, very available and can be done on a fee-based account. The access to securities-based lending, right? S block, very available, can be integrated depending on different custodians, more or less. There's brand recognition when we start looking at some of these custodians like Fidelity, Schwab, and Goldman Sachs. And so the idea that the clients themselves won't understand, or the clients may be adversely affected because they don't have access to the same thing, is actually the exact opposite of what's happened here over the last 5 years. And not only that, but these firms themselves in the RIA space, because they're not hampered typically with legacy technology platforms, they're on the leading edge of the fintech here. They're on the leading edge of integrating AI to create actually a better service paradigm for advisors to be able to service more clients and for clients to get better serviced as well, leveraging AI, more efficiency. So it's really become the tip of the spear from a client, right? Client product access to tools and resources, as well as the advisor's access to tools and resources.
100%. I totally agree. Where What do you want to cover first in terms of options? Let's pivot to some of the options in the industry. What do you think we should cover first from just, categorizing the different options out there for an advisor that's interested in the RIA world?
I'd say from that side of it, kind of touch on the different platforms, right? So there's RIA platforms, RIA roll-ups, RIA strategic acquirers, which can be both integrators and aggregators. And even within the platforms, there's the traditional PAG type platform, and then there's the dynasty type platform. So there are platforms that will be low cost. There are platforms that actually allow you to have your own ADV. So it's those would be the four different silos I would talk about when you start talking about platforms. And then that can then evolve into how equity can work across the channels as well, right? And the
I'm just gonna kick it off to you, and I'm just gonna say,
okay.
all right. So, Jeff, let's pivot to the different types of options that are out there for financial advisors in the RIA space. As mentioned, hundreds of different options, tons more coming out almost on a monthly, yearly basis. Can you just give a high level of the different types of options that are out there, and then we'll kind of dig in more granularly from there?
Yeah, certainly. Right. So we'll put it in different categories within the RIA space. One of the categories that seems to be the most in the press are the category of strategic acquirers. Strategic acquirers are those they're acquiring practices on a regular basis. Now, in the strategic acquisition space, there's actually two different categories. There's integrators and aggregators. And integrators are typically going to have one brand, typically one portfolio management structure, and it's a lot of more assimilation and integration, homogenized in their approach. The aggregators are going to be, more of just aggregating together, and those aggregating together are generating price efficiencies and some scale there, but they're really running their own individual businesses. So you actually may see some overlap in certain areas. You could have overlapping CEOs, for example, right? Multiple CEOs over each individual firm that's aggregated together. And the advisors aren't going to be, the advisors and support staff are going to be are going to be separated out. There are pros and cons into each of integrators and aggregators, and let's just go to the different categories first before we weigh in on that. So the next category is what we would look at as platform providers. And platform providers, they themselves can fall into three different categories. One level of platform provider actually allows you to do your own RIA. So they actually provide services to you under your own ADV. That there's a benefit for that for a lot of folks, right? Why do you want to have your own ADV? There could be things that you want to do and how you managing clients that is very specific. And so you would want to have the control over that in your own ADV. And so there are platform providers that can provide resources and support there. The more common area is platform providers using a common ADV, but a lot of flexibility inside that common ADV. So you could actually choose a custodian because there's flexibility across multiple custodians, and then there's scale across multiple custodians. So for someone who may not have, several billion in assets, they still want, high quality service and access to information and product. These platform providers can do that as well, and provide those tools and resources. So that's in the RIA space. And then there's other platform providers that also are doing roll-ups. And a roll-up platform provider are those that are providing similar resources to the group I just mentioned, but they're actually doing it where they're acquiring a percentage of your business. And then with a future opportunity of a liquidity event to actually generate a whole lot more revenue or wealth for everybody in a future liquidity event. And so it's almost like paying to get into a club, and you get greater resources and support. And, with also a future upside liquidity event by once you're in the club. And so these are a different level of platform providers, but it's kind of the three different categories. So those in broad terms are kind of five different ways that we see RIAs affiliate, or advisors affiliating with the different types of RIAs, I should say.
So let's talk about platform providers first. And in my opinion, that's where the most options are. That's where like the broadest scale of value proposition is. So, these firms can be a lot of different things. Let's take out the one where you have your own ADV for a second. Like 95% of the options that are out there in the industry, they're kind of going to be set up like an independent broker dealer, but on a multi-custodial platform. At the end of the day, their base job is handling compliance, building your tech stack, troubleshooting the tech stack, doing billing, all of the things that are going to get in the way of you taking care of your clients and servicing your business. Most of these firms are multi-custodial, so you can have some of your assets at Schwab, Fidelity, Goldman Sachs, Raymond James, LPL, Altruist, all of these different custodial partners that are out there. And the payouts and value proposition can range pretty significantly, but it can be as bare bones as just handling, compliance, technology, billing, some of the things that I just mentioned. And it could go as far to, having as much support as an independent broker dealer. They have, outsourced money management. They have research. They have a financial planning team. Maybe they have CPA or tax services or ultra high net worth services embedded in this organization. So there's hundreds of options out here inside of this that we can help you search, figure out what is the right fit and what's the right combination of, payout and resources for you to utilize on a day-to-day basis. So hundreds of options there in this platform provider space for sure. Jeff, anything else that you want to mention in terms of the platform provider space?
I do. I want to come back to your first statement, which was, hey, let's pull out the group that supports people with their own ADV. But let's talk about that for a second as well, because I absolutely believe one of the first thoughts most advisors have is, why don't I just do my own independent RIA? And so, first of all, there are firms that can support that, right? They can provide a lot of platform resources to somebody having their own independent RIA.
Yeah.
But I think what people really want to consider, right? And this is what we talk about when talking to clients about having their own independent RIA. We really try to challenge them and ask them what they're trying to achieve. And we talk about the scale that may be required, right? There's a lot of different cost components to having your own independent RIA that a lot of advisors don't think about. And the way we think about it is, if anyone's above 2 billion in assets, then it's a meaningful conversation to look at what are the pros and cons in the weeds of having your own independent RIA. And we have clients that we've worked with in that size that have started their own independent RIA, and we have clients that we've worked with in that size have chosen not to start their own independent RIA. But in that size, it absolutely starts to make sense to have your own independent RIA. Below that amount, it really starts to become more and more questionable. And I would describe it as even a gray area, between the 2 billion and potentially as low as a half a billion. And it's a more meaningful conversation. But below a half a billion, it almost never financially makes sense to start your own independent RIA. Right. Now, again, if we're going to look at numbers to numbers and pure apples to apples on cost, then you could potentially be more profitable. But if you're going to factor in risk, which you of course have to, because if it's your own ADV, it's your own RIA, there is a risk component to this. And you're going to factor in time and how much time you're going to spend, it almost never makes sense in those amounts unless it's not about cost, right? And so that's part of the question where if you're looking at starting your own independent RIA, then you really want to look at it from a risk and time perspective of what you stand to achieve versus what you stand to give up, and then add cost as an overlay on top of that. So that's one of the things that I think is really important for people to understand is there's a whole lot to the setting up your own ADV that people don't really consider. The last thing I'll say on this is the one thing that I hear from a lot of advisors who think about setting up their own ADV is they say, look, as long as I take care of my clients and I'm a fiduciary for my clients, I really don't have risk. And my comment to advisors when they mention that to me is frequently, well, while that is true, remember the last time you had a compliance meeting and or an audit from a firm about, on an annual basis or biannual basis, or however often they do it these days. The conversation around how you manage client assets is probably about 10% of the overall audit. And the other 90% is what a lot of advisors think is those gotcha items. And that's when you have your own RIA, that's the stuff you have to be paying attention to, because that's the stuff the regulators, whether it's the state or the SEC, is paying attention to. So your underlying premise on eliminating that, I think it warrants a lot of conversation. I've spent probably too much time on it for most people, but it's certainly an important conversation. Coming back to the platforms that you talked about, look, everything that you said is right on point on these platforms. The key to it all is there are high cost, there are low cost, right? There's high value, there's low value. There's a lot of different firms that are doing a lot of creative things. Net to absolutely have success and driving advisors' success in this space, right? And so they can provide a ton of resources and scale to actually be able to better service their client. And remember, one of the things that's really important in the RIA space is for those advisors that have chosen an independent custodian like a Schwab or an IWS as their custodian, if they ever decide to change firms, those clients don't have to get repapered again. So there's no new ACATs. You can keep those assets at Schwab, and you can change different firms from an RIA where you're under a platform to a different platform to your own RIA to then selling it to a strategic acquirer, never having to repaper those client accounts. It's just a simple e-signature with a change of ADV. And so there's a lot of freedom and flexibility that advisors love in that custodial space for that reason.
Well, Jeff, I really appreciate the time today. I mean, obviously, a lot of complexity in the space, new options all the time. As you said, lower payout, much higher service and support. And then there's also, really bare bones organizations out there as well where you can maximize your payout, control your local P&L as much as possible, and invest locally in terms of what's really really important to you. So I appreciate you giving an overview on all of this today. As you can tell, just a ton of options out there in the market space, in the marketplace. If you heard anything that interests you today, please reach out to us. Take a look at our website. We have a ton more videos on there, white papers, case studies to just help you get more educated on the marketplace and also just give you a better idea in terms of what it's like to work with us throughout this process. So I really appreciate the time. Jeff, thank you so much. And I hope you have a great day.
Thanks, Corey. Thanks, everyone.